Financial Risk-Taking, An Introduction to the Psychology of Trading and Behavioral Finance by Mike Elvin, book summary in English. Hey everyone, and welcome back to PowerBooks. In our quest to master the markets and truly understand what drives financial decisions, we often focus on charts, strategies, and economic indicators. But what if the most crucial factor isn't out there, but right inside us? Today, we're diving into a fascinating exploration that bridges the gap between the human mind and the financial world. Financial Risk-Taking, An Introduction to the Psychology of Trading and Behavioral Finance by Mike Elvin. This isn't just another book on trading techniques. Elvin takes us on an insightful journey into behavioral finance, revealing how our innate psychological biases, both cognitive and emotional, profoundly influence our perception of risk, our trading decisions, and even the collective dynamics of markets, leading to booms and busts. If you've ever wondered why you react a certain way to gains or losses, why seemingly rational investors make irrational choices, or how mass psychology can move markets, this book is for you. It's an essential guide for anyone looking to understand the human element of finance, mitigate their own behavioral pitfalls, and ultimately become a more disciplined and effective participant in the financial world. So, if you're ready to uncover the hidden psychological forces at play in financial risk-taking, hit that like button, subscribe to PowerBooks if you haven't already, and let's begin financial risk-taking. Part 1. The Psychology of Financial Risk-Taking. Chapter 1. Risk in Financial Markets. In this foundational chapter, Risk in Financial Markets, Mike Elvin sets the stage for understanding the psychological dimensions of financial decision-making by first clearly defining and categorizing the various forms of risk inherent in financial markets. He likely explains that risk, in this context, is not merely the potential for loss, but encompasses the uncertainty of future outcomes and the variability of returns on investments. Elvin would detail different types of financial risk that investors and traders commonly encounter. These typically include market risk, or systematic risk, which affects the entire market due to broad economic or geopolitical factors, and specific risk, or unsystematic risk, which is unique to individual assets or companies. He would also cover crucial concepts such as liquidity risk, the difficulty of buying or selling an asset quickly without impacting its price, credit risk, the risk of default by a borrower, and operational risk, losses from internal failures. The chapter might briefly touch upon basic methods for quantifying risk, such as volatility or drawdown, and emphasize the fundamental principle that higher potential returns generally necessitate taking on higher levels of risk. By clearly establishing these objective financial risk parameters, Elvin lays the essential groundwork for Part 1, allowing subsequent chapters to delve into how human psychology perceives, interprets, and often biases these inherent market risks. Key takeaways. 1. Defining financial risk. Mike Elvin introduces risk as the uncertainty and variability of outcomes in financial markets, beyond just the potential for loss. 2. Categorization of risk. The chapter details various types of financial risk, including market risk, specific risk, liquidity risk, credit risk, and operational risk. Risk-return trade-off. It emphasizes the fundamental principle that higher potential returns are typically associated with higher levels of risk. Foundational concepts. The core message is to establish a clear understanding of objective financial risks as a prerequisite for exploring their psychological dimensions in subsequent chapters. Chapter 2. Psychology and Risk. In this pivotal chapter, Psychology and Risk, Mike Elvin bridges the gap between the objective definitions of financial risk from the previous chapter and the subjective, often irrational ways in which human beings perceive and react to it. He likely challenges the traditional economic assumption of perfectly rational actors, introducing the field of behavioral finance as a more accurate lens for understanding financial decision-making. Elvin argues that risk is not merely an objective metric, but a deeply personal and emotional experience, heavily influenced by our inherent psychological wiring. The chapter probably introduces foundational psychological concepts that directly impact risk-taking. Key among these would be an early discussion of heuristics, the mental shortcuts we use that can lead to systematic biases, and the powerful, often overriding role of emotions in financial choices. Elvin would likely delve into the influential prospect theory, explaining how individuals tend to evaluate potential gains and losses differently, often exhibiting risk aversion for gains, but becoming risk-seeking when facing losses. This theory's core concept of loss aversion, the idea that the pain of a financial loss is psychologically more potent than the pleasure of an equivalent gain, would be central to understanding irrational behavior. Through various examples, the chapter demonstrates how these inherent psychological mechanisms can lead investors and traders to make suboptimal decisions, setting the stage for a deeper dive into specific cognitive and emotional biases in subsequent chapters. Key takeaways. 1. Subjectivity of risk. Mike Elvin establishes that risk perception is a subjective psychological experience, not purely an objective financial metric. Introduction to Behavioral Finance. The chapter introduces the field that explains deviations from rational economic behavior due to psychological factors. Foundational concepts. It highlights key ideas like heuristics, biases, the role of emotions, and especially introduces prospect theory with its concept of loss aversion. Impact on decision-making. The core message is that inherent psychological mechanisms significantly influence how individuals perceive and react to risk, often leading to irrational financial decisions. Chapter 3. Cognitive Biases, Decision-Making in the Face of Risk. In this crucial chapter, Cognitive Biases, Decision-Making in the Face of Risk, Mike Elvin dives deep into the systematic errors in thinking that fundamentally distort our rational judgment, particularly when evaluating and taking financial risks. Building on the previous chapter's introduction to the subjectivity of risk, he meticulously explains that cognitive biases are predictable patterns of deviation from rationality, often stemming from mental shortcuts or inherent limitations in how our brains process information. Elvin likely details several key cognitive biases highly relevant to financial markets. These would include confirmation bias, where individuals seek out and interpret information that only confirms their existing beliefs. For example, a trader focusing solely on news that supports a stock they already own. He would also cover anchoring bias, demonstrating how an initial piece of information can disproportionately influence subsequent judgments, like fixating on a stock's historical high price. Other probable biases discussed are the availability heuristic, leading to overestimating the likelihood of vivid or easily recalled events. Overconfidence bias, causing individuals to overestimate their own abilities or the accuracy of their predictions. And the sunk cost fallacy, where prior investments of time or money irrationally influence future decisions, such as holding on to a losing stock because of past losses. The chapter powerfully illustrates how these systematic thinking errors lead to suboptimal financial behaviors, ranging from poor diversification and excessive trading to holding losers too long and selling winners too soon, underscoring the critical need for awareness to mitigate their impact. Key takeaways. 1. Definition of cognitive biases. Mike Elvin explains cognitive biases as systematic, predictable errors in judgment that arise from the way our brains process information. Key biases explained. The chapter details common cognitive biases like confirmation bias, anchoring bias, availability heuristic, overconfidence bias, and sunk cost fallacy with financial examples. 3. Impact on financial decisions. It demonstrates how these biases lead to irrational behaviors, such as poor investment choices, suboptimal risk management, and deviations from a sound trading plan. 4. Awareness as first step. The core message is that recognizing these inherent thinking flaws is the essential first step towards making more rational and effective financial decisions. Chapter 4. Emotional biases, feelings, and financial decisions. In this illuminating chapter, Emotional Biases, Feelings, and Financial Decisions, Mike Elvin shifts focus from cognitive distortions to the powerful, often subconscious influence of our emotions on financial risk-taking. He explains that emotional biases are systematic deviations from rational decision-making driven by feelings, impulses, and intuitions, often proving more challenging to correct than purely cognitive errors. Elvin likely emphasizes how these biases can override logical analysis, leading to suboptimal choices even when individuals possess clear information. The chapter probably delves into several key emotional biases relevant to financial markets. Loss aversion is revisited and expanded upon from an emotional perspective, highlighting the profound pain associated with realizing losses, which often leads to irrationally holding on to losing positions. Regret aversion is explored, showing how individuals may avoid decisions that could potentially lead to future regret, whether from taking action or remaining passive. Elvin would certainly discuss the classic market drivers of fear and greed, illustrating how fear can trigger panic selling during downturns and prevent participation in recoveries, while greed can lead to chasing unsustainable returns and excessive risk-taking. Other probable biases include over-optimism, which fuels unrealistic expectations, status quo bias, leading to inaction and resistance to necessary portfolio adjustments, and herding behavior, where the emotional comfort of following the crowd outweighs independent rational analysis, a form of FOMO. The chapter powerfully demonstrates how these deep-seated emotional responses significantly impact trading and investment decisions, underscoring the necessity of recognizing and managing them to foster more disciplined financial behavior. Key takeaways. 1. Defining emotional biases. Mike Elvin explains emotional biases as systematic deviations from rational decision-making primarily driven by feelings and impulses, often harder to correct than cognitive biases. 2. Key emotional biases. The chapter details crucial biases such as loss aversion from an emotional standpoint, regret aversion, fear, greed, over-optimism, status quo bias, and herding behavior. Impact on financial decisions. It illustrates how these emotional responses lead to common irrational behaviors like holding losing positions, chasing returns, and deviating from disciplined strategies. 4. Challenging but crucial to manage. The core message is that understanding and actively managing these powerful emotional forces is essential for making more rational and effective financial decisions. Chapter 5. Personality, Biology, and Risk. In this concluding chapter of Part 1, Personality, Biology, and Risk, Mike Elvin delves into the deeper, more intrinsic factors that shape an individual's approach to financial risk-taking, moving beyond universal biases to explore unique personal predispositions. He argues that while cognitive and emotional biases are common, the degree to which individuals are susceptible to them and their inherent risk tolerance is significantly influenced by stable personality traits and biological underpinnings. Elvin likely explores the relationship between widely accepted personality models such as the Big Five: openness, conscientiousness, extroversion, agreeableness, neuroticism, and various aspects of financial behavior, such as a conscientious individual's tendency towards disciplined risk management, or a highly neurotic individual's increased emotional reactivity to market fluctuations. The chapter would then venture into the fascinating realm of biological factors, discussing how genetics may contribute to baseline risk propensity. He would probably detail the influence of neurotransmitters like dopamine, linked to reward-seeking and impulsivity, and serotonin, affecting mood and emotional stability, as well as hormones such as cortisol, stress response, and testosterone, confidence and aggression, all of which can subtly or overtly impact financial decisions in real time. By understanding these inherent individual differences, Elvin emphasizes the crucial role of self-awareness in tailoring trading strategies and risk management approaches to align with one's unique psychological and biological profile, rather than fighting against inherent tendencies, thereby fostering more sustainable and effective financial risk-taking. Key takeaways. Individual differences. Mike Elvin highlights that risk-taking is significantly influenced by unique personality traits and biological predispositions, not just universal biases. 2. Personality's role. The chapter discusses how specific personality traits, e.g., from the Big Five model, correlate with different approaches to financial risk and discipline. 3. Biological influences. It explores the impact of genetics, neurotransmitters, dopamine, serotonin, and hormones, cortisol, testosterone, on risk perception and decision-making. 4. Tailored self-awareness. The core message is that understanding one's own inherent psychological and biological tendencies is crucial for developing personalized and effective financial risk management strategies. Part 2. Applying the Psychology to Financial Trading. Chapter 6. Trading Strategies and Psychological Biases. In this pivotal chapter, Trading Strategies and Psychological Biases, Mike Elvin transitions from the foundational understanding of psychological principles to their direct and often detrimental impact on financial trading. He explicitly highlights how even the most logically sound trading strategies can be undermined by the inherent cognitive and emotional biases discussed in Part 1, particularly during the critical phase of execution. Elvin argues that success in trading is not solely about having a winning strategy, but about effectively managing one's own psychological tendencies. The chapter likely illustrates how various biases manifest within common trading approaches. For example, in trend-following strategies, confirmation bias might lead a trader to ignore evidence that a trend is reversing, resulting in holding on to losing positions too long. For mean reversion or counter-trend strategies, loss aversion and the sunk cost fallacy can cause traders to average down on losing trades rather than cutting them, hoping for an unlikely rebound. Elvin probably discusses how overconfidence can lead to excessive position sizing, while herding behavior or FOMO, fear of missing out, can compel breakout traders to chase prices that are already extended. He emphasizes that both discretionary and systematic traders are susceptible. Discretionary traders face real-time emotional interference, while systematic traders might allow biases to subtly influence their rule development or override their systems during stressful periods. By providing concrete examples of how psychological biases directly impede effective strategy execution, Elvin sets the stage for the crucial role of risk management and emotional discipline in subsequent chapters. Key takeaways. 1. Bias in strategy execution. Mike Elvin emphasizes that even well-designed trading strategies can fail due to psychological biases during their implementation. Specific bias manifestations. The chapter illustrates how various cognitive and emotional biases impact common trading strategies, e.g., trend following, mean reversion, breakouts. 3. Undermining discipline. It highlights how biases like confirmation bias, loss aversion, overconfidence, and herding lead to deviations from a sound trading plan. 4. Awareness for mitigation. The core message is that recognizing these psychological interferences is crucial for traders to address their behavioral pitfalls and improve execution. Chapter 7. Risk Management and Psychological Traps. In this critical chapter, Risk Management and Psychological Traps, Mike Elvin delves into one of the most vital aspects of long-term trading survival: the consistent application of sound risk management principles. He argues that even when traders intellectually understand and establish robust risk rules, their inherent psychological biases and emotional tendencies frequently lead them into dangerous psychological traps that undermine these very safeguards. Elvin likely details several pervasive traps that derail effective risk control. A primary focus would be the common failure to adhere to stop losses or the tendency to average down on losing positions, driven by potent forces like loss aversion, the pain of realizing a loss, and the sunk cost fallacy, unwillingness to abandon a prior investment. He would also explore how overconfidence and greed often lead to excessive position sizing or over-leveraging, exposing traders to disproportionate risk. The chapter would probably highlight the trap of regret aversion, where fear of missing out on further gains prevents traders from taking profits, leading to reversals. Furthermore, Elvin might discuss revenge trading, an impulsive response to losses driven by anger and a desire to quickly recoup funds, which almost invariably leads to further, larger losses due to abandoned risk principles. By vividly illustrating how emotional and cognitive biases manifest as direct threats to disciplined risk management, Elvin underscores the paramount importance of psychological awareness and self-control in protecting trading capital and ensuring long-term viability in the markets. Key takeaways. 1. Risk management vulnerability. Mike Elvin emphasizes that despite intellectual understanding, psychological biases frequently undermine effective risk management in trading. 2. Common psychological traps. The chapter details specific pitfalls like ignoring stop losses, averaging down, excessive position sizing, failure to take profits, and revenge trading. Bias as the root cause. It illustrates how biases such as loss aversion, sunk cost fallacy, overconfidence, greed, and regret aversion directly fuel these dangerous risk management failures. 4. Awareness for survival. The core message is that recognizing these psychological traps is absolutely critical for traders to protect their capital and maintain long-term success in the markets. Chapter 8. The Psychology of Losing and Winning. In this insightful chapter, The Psychology of Losing and Winning, Mike Elvin delves into the profound emotional and behavioral impact of trade outcomes on an individual's financial decision-making. He highlights that trading is an inherently emotional endeavor, characterized by the frequent highs of wins and the inevitable lows of losses, and that how a trader psychologically processes these results critically determines their long-term success and well-being. Elvin likely dissects the psychology of losing, detailing the emotional toll of drawdowns and losing streaks, which can range from frustration and anger to fear and self-doubt. He would illustrate how these negative emotions often trigger detrimental behaviors, such as revenge trading, seeking to quickly recoup losses, analysis paralysis, becoming too fearful to act, or prematurely abandoning a valid trading system. Conversely, the chapter would also explore the psychology of winning, revealing how success can induce euphoria, overconfidence, and greed. These positive emotions, while pleasant, can lead to equally dangerous behaviors, such as taking on excessive risk, increasing position sizes irrationally, deviating from one's trading plan, or succumbing to the gambler's fallacy by believing a winning streak will continue indefinitely. Elvin emphasizes that managing both the elation of winning and the despair of losing is paramount for consistent performance. The core message is to cultivate an outcome-independent, process-oriented mindset, where focus remains on disciplined execution of a sound strategy rather than being swayed by the immediate emotional fluctuations of profit and loss, thereby enabling continuous learning from all outcomes. Key takeaways. 1. Emotional impact of outcomes. Mike Elvin details the strong emotional responses, fear, anger, euphoria, greed, triggered by both winning and losing in trading. 2. Detrimental behaviors from losses. The chapter explains how negative emotions from losses can lead to revenge trading, paralysis, or abandoning sound systems. Dangers of winning. It highlights how even positive emotions from wins can lead to overconfidence, excessive risk-taking, and deviations from discipline. 4. Process-oriented mindset. The core message is to develop emotional regulation and a focus on consistent process adherence, rather than being swayed by the immediate outcome of individual trades to achieve long-term success. Chapter 9. Building Emotional Discipline and Resilience. In this highly practical chapter, Building Emotional Discipline and Resilience, Mike Elvin moves from diagnosing psychological pitfalls to providing actionable strategies for managing the powerful emotional forces that impact financial decision-making. He emphasizes that while intellectual awareness of biases is crucial, genuine and sustained improvement in trading requires the deliberate cultivation of emotional discipline, the ability to adhere to a plan despite emotional impulses, and resilience, the capacity to bounce back from setbacks. Elvin likely outlines several concrete techniques. For building emotional discipline, he would stress the absolute necessity of creating a comprehensive trading plan with predefined rules for entries, exits, and rigorous risk management, and then relentlessly pre-committing to those rules, for example, setting stop losses before a trade is even placed. He might suggest adopting a process-oriented mindset, shifting focus from immediate profit or loss to the consistent execution of one's strategy. To cultivate resilience, Elvin would probably advocate for reframing losses as valuable learning opportunities rather than personal failures, thereby reducing their emotional sting. Techniques such as mindfulness and stress reduction practices might be introduced to help maintain composure under pressure. Furthermore, he'd likely emphasize the foundational role of physical well-being, sleep, nutrition, exercise, in supporting mental fortitude. By implementing these strategies, Elvin demonstrates how traders can develop the necessary inner strength to navigate the inherent volatility and emotional challenges of financial markets, leading to more consistent performance and greater psychological robustness. Key takeaways. 1. Actionable strategies. Mike Elvin provides concrete methods for actively building emotional discipline and resilience in trading. 2. Emotional discipline techniques. The chapter emphasizes creating and adhering to a strict trading plan, using pre-commitment strategies and focusing on process-oriented goals to control impulses. 3. Resilience building. It outlines methods like reframing losses, mindfulness, and prioritizing physical well-being to enhance one's ability to recover from setbacks. 4. Foundation for consistency. The core message is that consistently applying these psychological strategies is essential for overcoming emotional traps and achieving long-term, stable performance in financial markets. Chapter 10. Understanding Market Bubbles and Crashes. In this expansive chapter, Understanding Market Bubbles and Crashes, Mike Elvin broadens the scope of behavioral finance from individual decision-making to the dramatic, large-scale phenomena of market bubbles and subsequent crashes. He explains that these periods of extreme market irrationality are not merely economic events, but powerful manifestations of collective human psychology, where individual cognitive and emotional biases aggregate to drive irrational crowd behavior. Elvin likely dissects the typical stages of a market bubble, from an initial displacement, like a new technology, that sparks interest, through a boom phase fueled by rising prices, to euphoria, where speculation becomes rampant and the greater fool theory takes hold. He would then detail how the bubble eventually bursts, leading to panic and a crash. The chapter emphasizes the psychological drivers behind these phases: herding behavior, the fear of missing out, or FOMO, and the comfort of following the crowd; confirmation bias, only seeing data that supports rising prices; overconfidence and greed during the boom; and recency bias, extrapolating recent gains indefinitely. Conversely, during a market crash, Elvin explains how acute fear and panic override rational thought, exacerbated by loss aversion and a reverse herding effect as everyone rushes for the exit simultaneously. He might illustrate these concepts with historical examples, such as the dot-com bubble or the 2008 financial crisis. By understanding these collective psychological dynamics, Elvin empowers individual investors and traders to recognize the signs of irrational exuberance or pervasive fear, enabling them to resist the emotional pull of the crowd and adhere to more disciplined, rational strategies during periods of extreme market volatility. 1. Collective psychology. Mike Elvin explains that market bubbles and crashes are driven by the aggregation of individual cognitive and emotional biases on a grand scale. 2. Phases of a bubble. The chapter outlines the typical stages of a bubble: displacement, boom, euphoria, panic, crash, and their underlying psychological drivers like herding and overconfidence. 3. Drivers of crashes. It details how emotions like fear, panic, loss aversion, and reverse herding fuel rapid market declines. Navigating market extremes. The core message is that understanding these collective psychological phenomena allows individual traders to maintain discipline, resist irrational crowd behavior, and make more rational decisions during periods of market exuberance or despair. Chapter 11. Future Directions and Personal Development. In this concluding chapter, Future Directions and Personal Development, Mike Elvin synthesizes the profound insights gleaned throughout financial risk-taking, emphasizing that understanding the psychology of financial decision-making is not merely an academic exercise, but a continuous journey of self-mastery. He reiterates the critical importance of recognizing how cognitive and emotional biases, coupled with individual personality and biological predispositions, profoundly impact our financial choices and market outcomes. Elvin likely casts an eye towards the future of behavioral finance, perhaps touching upon emerging research in neurofinance that further explores the brain's role in risk-taking, or the potential for artificial intelligence to help identify and mitigate human biases. More importantly for the individual, the chapter pivots to practical strategies for ongoing personal development. He would encourage readers to cultivate a habit of continuous self-assessment through meticulous journaling and honest introspection, allowing them to pinpoint their own unique behavioral traps and emotional triggers. Elvin would reinforce the necessity of building robust, rules-based decision-making frameworks to minimize impulsive, biased actions and stress the importance of emotional discipline and resilience, as discussed in Chapter 9. The core message is that by consistently applying these psychological insights, embracing humility, and prioritizing overall mental and physical well-being, individuals can navigate the complex world of financial markets with greater self-awareness, make more rational decisions, and ultimately achieve more consistent, sustainable success. Key takeaways. 1. Synthesis of learnings. Mike Elvin provides a recap of how understanding cognitive, emotional, personality, and biological influences on risk-taking is crucial. 2. Ongoing development. The chapter emphasizes that mastering financial psychology is a continuous process, requiring persistent self-awareness and adaptation. Future of behavioral finance. It offers a glimpse into emerging trends and technological advancements in the field. Practical self-improvement. The core message promotes strategies like continuous self-assessment, structured decision-making, and prioritizing well-being as foundational for sustained success in financial risk-taking. And that brings us to the end of our incredibly insightful journey through financial risk-taking, an introduction to the psychology of trading and behavioral finance by Mike Elvin. What an eye-opening exploration into the very human forces that shape our financial decisions and move the markets themselves. Elvin has brilliantly laid bare the profound impact of our cognitive and emotional biases, our personalities, and even our biology on how we perceive and manage risk. From the individual traps in trading strategies and risk management to the collective madness of market bubbles and crashes, we've gained an invaluable understanding of the psychological drivers behind financial success and failure. This book isn't just theory. It's a powerful guide to cultivating the self-awareness and discipline needed to navigate the markets more rationally and effectively. If you're serious about mastering your financial mind, mitigating costly behavioral pitfalls, and becoming a more composed and profitable trader or investor, then financial risk-taking is an essential addition to your arsenal. You can find the link to get your copy in the description right below. Here at PowerBooks, we firmly believe knowledge is not power. The application of knowledge is power. And Mike Elvin's work provides the foundational insights you need to apply that psychological knowledge directly to your financial endeavors. If you found this breakdown valuable and are ready to take control of your financial psychology, make sure to hit that like button, subscribe to PowerBooks, and ring that notification bell so you don't miss our next empowering summary. Keep learning, keep evolving, and keep making smarter financial decisions. Thanks for tuning in, and we'll see you next time on PowerBooks.